This week there's been a barrage of new property and economic data that's giving us an indication of what's ahead for our housing markets. So today in our Property Insider chat, Dr. Andrew Wilson and I discuss about how our economy is performing, latest housing loan approvals, building approvals, construction costs, and the auction results that give us a good in-time indicator of what's happening on the ground in the markets. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you up to date each time a new show comes out. Around this time last year, the media was telling us that interest rates in Australia were going to peak at 3.5%. And that they also mentioned there was a high likelihood that we'd be in the midst of a recession by the end of the year. Property prices were also forecast to drop significantly, with losses estimated to be up to 20% from their peak. Meanwhile, the banks were preparing for a mortgage cliff, billions of dollars worth of home loans resetting at a higher interest rate, which was expected to cause a raft of distressed and mortgagee sales. None of these predictions on the housing market, the bank side, played out, and clearly, the recession didn't come either, did it? Australia's economy has remained stable, in fact, performing probably a little too strongly for the Reserve Bank's liking, and clearly we've avoided the recession despite the cash rate being at much higher than anticipated, 4.35%. And nationally, house prices and rents have kept rising. Now, I enjoy my weekly chats with Australia's leading housing economist, Dr. Andrew Wilson, chief economist of my housing market, because he brings his years of perspective to analysing what's going on in our economy. He's seeing clarity in the chaos that many other people are seeing. And that's why when we look back at our discussions a year ago, you're going to see none of those dire predictions were made. In fact, Andrew was very accurate in his forecasts. So today I'm going to have a chat with him about a raft of new data that's come out over the last week to get his thoughts on how this would affect our housing markets. Hi, Andrew.
Yeah, good day, Michael. It was nice to have that little journey down memory lane and remind us of all the silly stuff that we are confronted with in the media. I don't know how they look at themselves in the mirror, particularly those commentators who keep predicting these catastrophic events which just never happen. And in fact, it's not sort of by degree that they fail. They fail in the actual direction. They're saying down and it goes up. They're saying flat and it rises, and it's just remarkable that the media keeps buying this rubbish cycle after cycle, because we've actually heard this now for, I'd say, decades, Michael. But the good thing is, I think by and large, the robust nature of the housing market means that our media is just about completely ignored now, and I think that reflects its relevance to the public in general, and that's why they're struggling. But yes, in fact, this year is probably likely to be a stronger year again than many have predicted, certainly on what we've seen to start with. But there's no sign of relief in the inconsistencies and the imbalances that we have in our housing market now, which are almost systemic, particularly the rental market.
Well, there's also news of recession coming up, per capita recession, real recession. So that's in the media as well. But let's have a look at some of the data that's come out over the last week, because that'll give us an indication of what's moving forward. Clearly, there's been a lack of supply in our housing market.
Yeah.
We're not building enough dwellings to accommodate the large number of new immigrants, plus our growing population. Some recent home building approval data came out, Andrew. What's your interpretation of that?
Well, when we look at the private sector specifically, and that's, of course, the most relevant because it reflects generally market forces, Michael, the ABS, when they do their aggregate numbers for building approvals for homes, they include the public sector. So that's why there's a marginal difference here between the headline numbers from the ABS and what we're reporting here, because what we're reporting is strictly private sector building approvals for homes. And there's not a big difference in the sense, because there's a very small proportion of the overall new building approvals that are actually publicly funded. Most of it is private sector. But when we look at the data, private sector building approvals, home building approvals, fell slightly by 0.3% over January, but that followed that 10.6% December fall. But a lot of these changes from month to month, Michael, are due to the volatility of the unit market. you can tend to get a very large number of unit developments from month to month. We can have a number of thousand actually on a month by month basis, large apartment developments. And of course, if we don't get the follow up, we see a big rise and then we see a big fall. And that's what we've seen to some degree with the January data, Michael. Overall home building approvals down by 0.3% over January. And that followed the 10.6% December fall. And it was all about the units. Units up by 19.5%. So once again, a volatile number of units being approved. So we had a big rise in the overall numbers. But I think what was concerning, Michael, is approvals for houses were down 9.9%. And that's actually a big fall for houses, which tends to be a lot more stable than apartments. And that contributed to very modest rise of just 0.3%, despite that big number for units. Queensland was the number one state for building approvals for homes, reflecting the unit boom that's going on there, particularly in southeast Queensland. Queensland was up by 31.8%. I'm reiterating again that this is reflecting a large number of approvals for units that came through over the month. But those annual growth levels still remain chronically depressed when we look at that. But the quarterly trend is starting to steady, Michael. So maybe a sense there that we're now trundling along the bottom. The overall numbers, seasonally adjusted over January, were 12,699 total approvals. We've got to remember that we probably need about 200,000 approvals turning into actual commencements and completions to just match what our requirements are on an annual basis. So we're not even with approvals, and we don't typically see approvals translating to the same number as commencements and completions, but we're still well below just our replacement number, Michael, which is around that 200,000 mark on an annual basis where we're tracking now. So,
Andrew, it's very likely that we're starting with a deficit anyway. So we've actually more to do to catch up before we even get to replacing what's required.
Yeah, that's the systemic problem, Michael, that we're well below because of the underbuilding that it's occurred, which is government policy, bureaucratic a result. But don't mix ideology with reality, because once that happens, you get into this terrible mess that we're in now, and in terms of trying to supply our population with appropriate housing. But yeah, we're certainly still tracking under that 200,000 a year replacement number. And as you said, that's not even accounting for what we have the big deficit at the moment. And when we look at the breakdown over the month, yes, 3% increase, marginal increase, so basically flat, 19.5% up for units, but 9.9% down for houses, which, as I said, is quite a concerning result there for houses, because they tend to be a lot more stable from month to month. But the year to date, so January compared to last January, units are higher, again reflecting that volatility over a monthly period. But houses are down 4.7%, and total up 5%, again reflecting what's happened with units over this month, or the month of January. But over the full year, so the full year ending January this year compared to the same period ending January last year, we're well down on what we built. So, and in trend terms, our underlying trend still remains 38.5%. That's the annual monthly trend, 38.5% fewer. And that peak was back in 2016, Michael. So as you were saying, we haven't been replacing what we've needed. We've come into a deficit market, and even now we're just trundling along the bottom and not building enough just to replace our current needs going forward. And when we look at the breakdown in that trend between houses and units, it's really units which have really collapsed in terms of new building approvals, down by 55.6% since 2016. So we've clearly underbuilt, and we're paying the price now. And clearly units have been the main contributors to that underbuilding, although houses, as I mentioned, have now started to concerningly fall away, which is, again, just adding to that undersupply we have, and upward pressure on rents, upward pressure on prices. When we look at the capital city data over January, Michael, again, Melbourne well and truly ahead. Melbourne typically produces around 40% of overall home building approvals, 40% of all the capitals. Again, it's well ahead of everywhere else in terms of the number of homes approved over January. Good news for the Melbourne economy. And I think perhaps maybe there's an argument there, Michael, that's part of why Melbourne is a better supplied housing market than some of the other capitals, and it hasn't recorded perhaps the same sort of upswing in prices and rents. I think there are other factors, important other factors, but maybe that's one of them, the fact that Melbourne has a better supply line compared to the other capital cities, which is keeping a little bit of a control over rents and prices. But we are starting to see particularly unit rents on the rise in Melbourne. Michael and I suspect that will continue now, with Melbourne starting to catch up with the other capitals.
Well, we also got some information about home building costs, and I know my housing market keeps a track of that carefully. There's no really good news there either.
No, Michael, this was a real concern. We continue to see house building costs rise from their peak growth rates, which of course was due to that home builder policy from the previous government that created so much demand, or brought so much demand forward, that we didn't have enough supply to cater for it, so costs went through the roof. We had started to see a generalised easing in those annual cost levels, but they actually bounced back over January, Michael. And you've got to understand that when the ABS, and this is very relevant for interest rates, because the ABS inflation data, when it looks at housing costs, basically rents, and that's total rents, not just asking rents, and also house building costs, not unit building costs, but house building costs. So it's important to keep an eye on house building costs, because they are a significant contributor to the basket of goods for housing that the ABS uses for its inflation data. As I mentioned, we've seen a bounce back following, when we look at the annual growth rates, which of course are relevant to the inflation number, we can see that the annual growth rate has actually picked up now to 7.5%. And that's the first rise we've had in some time, that annual rate of the index, Michael. So, and when we look back, the last rise we had was actually over the early period of 2023. And during that period, we had an interest rate increase. So look, some concerning data there in terms of house building costs, which will work their way, if sustained, back into a higher inflation rate, which certainly isn't good news for those predicting interest rate cuts, which I think is a bit of a silly prediction at the moment, but maybe those that are wary of more interest rate increases, particularly as oil is starting to rise as well. So unfortunately, no good news there for house building costs, and a bit of a surprise, Michael, that data, because it has been certainly trending downwards over the past year or so. And now the other point, you mentioned all those scary headlines about recession. We had our latest GDP numbers out, and annual economic growth just slowed a little bit. Quarterly growth rate was steady at 0.3%, but the annual growth rate slowed down to 1.3%. A little lower, but as you said, really no sign of a recession there. Growth is still reasonably solid, given the factors, particularly retail spending is still high and government spending still solid. That's really no surprise.
Another data set that came out over the week was home loans. Track home loans because it gives us a good indication of what's likely to happen to our housing markets moving forward, Andrew. And what did you get from that?
Well, a bit of a surprise again, Michael. We've actually seen the last few months a fall in seasonally adjusted housing loans, despite the fact that housing markets are still quite vibrant. The ABS has been quite open about the issues it's been having with its housing loan data. So maybe we need to take this, particularly the seasonal adjustment models, with a bit of a grain of salt at the moment. But I think what was interesting, Michael, from the data, particularly interesting, was when we looked at the breakdown, and just to say that loans were down 4.1% over the month, and that was the second consecutive fall in overall home lending. So as I said, a little bit of a surprise, but we did see an easing in auction market clearance rates over the end of the last month. So perhaps that's working its way into those lending numbers. But when we look at the buyer type breakdowns, Mike, I think it's interesting that even though we saw overall owner occupiers down and down quite sharply, and also investors down, we saw another rise in first home buyer numbers. So first home buyers have actually gone against the trend of the last few months and have been higher. And I think this just sort of validates all those significant drivers for first home buyers at the moment. Of course, we have skyrocketing rents, high inflation, which impacts savings capacity for first home buyers. And of course, the real driver for first home buyers is high prices. When they see prices rising, with those other factors, they're certainly motivated to get into the market as owners. And I think we're seeing that in the data, that motivation. So the proportion of first home buyers to the total market is rising now. And as I said, I don't think there's any surprise that that's happening.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. We also have a regular chat about what's happening in the auction markets, because that gives us a better indication of what's happening on the ground, Andrew. And earlier on in our chat this morning, you mentioned that you wondered that our markets are going to be performing more strongly than even you predicted.
Yeah, I'm thinking about changing my forecasts, Michael, which I don't do often, but they're still around about the mark. But certainly had a strong start to the year. And the reason, as you said, we track auction clearance rates is that they also track house prices. So they're a good week by week indication of what's happening in the underlying dynamic of our housing markets, particularly the bigger auction markets, but even the smaller auction markets, to give us a good guide to what's happening almost in real time, Michael, every Saturday night. And we can see that with our charts that show clearly Melbourne and Sydney, particularly clearance rates tracking prices, higher clearance rates, lower prices, lower clearance rates, lower prices. Higher prices. You know what I mean? Lower clearance rates, lower prices. But of course, we had a long weekend holiday this weekend, Michael, and I'm not just talking about Melbourne. Adelaide and Canberra also had long weekends. So most of our capital city auction markets had a break, in a sense. We're distracted by long weekends. To Canberra, it was Canberra Day. Adelaide was the Adelaide Cup, and of course Melbourne had Labor Day, long weekend holiday, which we're all enjoying in Melbourne, Adelaide and Canberra today. But it didn't really have a big impact on our auction markets, again reflecting just how strong our auction markets have been this year. Yeah, we still had more solid to strong results despite the distractions of the long weekend in most of those capitals. And of course, next weekend, markets resume at full pace. Higher listing numbers will again test markets ahead of the upcoming Easter break, which is just in a couple of weeks' time, Michael. But the actual numbers, very similar numbers in Sydney, big numbers. Sydney didn't have the long weekend, but 847 auctions in Sydney, which is a big number for this time of the year, similar to the previous Saturday. Auction clearance rate, similar as well, 74.5%. Good result there for sellers, 3/4 of the offered stock going under the hammer, as reported. And you can compare to a year ago in Sydney, Michael, just 584, so 300 more auctions. So that Sydney market's still got a head of steam up. And I think when we've discussed the prospects for Sydney, we've reinforced that the Sydney median house price is still below where it was at its peak. So there's still value in that Sydney market. And that's why we're not surprised it's still growing, because buyers are still recognising that they can buy property in Sydney for a price that's lower than where it was a year ago. I think that's what's helping that Sydney market along. Melbourne had the long weekend, just 359 auctions in Melbourne, which followed 1,144 the previous weekend. No surprise, long weekend. Melbourne actually had a higher clearance rate, 67.5% compared to the previous weekend. Not a bad result there for Melbourne, but Melbourne has been, as we've discussed, a bit of an underperformer for various reasons, but still, I'd suggest still that's worthy of consideration for sellers in Melbourne's market. I think there's still plenty of buyers around for the right property in Melbourne. But when we compare that again to the same weekend last year, Michael, well ahead in terms of the numbers, nearly 100 more auctions compared to the same Saturday last year, and a similar clearance rate. So I think a solid result there for Melbourne. Brisbane had a little bit fewer auctions, but a significantly higher clearance rate, 75.4%. Tends to be a bit of a volatile market, but again, performing its clearance rate better than the previous weekend, and numbers were higher and the clearance rate was higher compared to the same weekend a year ago. And that Adelaide market, back to the 80%, Michael. We've been used to weekend after weekend for a while getting an 80% clearance rate in Adelaide. We haven't had that for a while. But we've been
right last year, but it slowed down a little bit.
Yes, it did. Yeah, which I think is an affordability issue. And but back in town now, 83%. And good numbers for the long weekend there, 68 auctions. And again, when we compare it to the same weekend last year, well ahead in terms of the number of auctions and also the clearance rate is well ahead of where it was in Adelaide a year ago. And we're just starting to see some signs, Michael, that Canberra market, after a subdued period, Canberra, particularly the second half of last year, and of course there's a few local housing market policies that government has introduced recently, and maybe that's had a bit of an effect in the shorter term on the housing market in Canberra, but starting to bounce back. Low numbers of auctions, 28 auctions, but the auction clearance rate was a little higher than the weekend before, but we're starting to move into the 60s now with that Canberra clearance rate consistently, well, certainly over the last month or so. And we were used to the 50s really for quite some time there in Canberra. So some positive signs. Numbers were down a little bit compared to the same weekend last year in Canberra, where there were 39 auctions. And the clearance rate, however, was significantly higher. As we've said, just some signs there that that Canberra market is finally coming out of the doldrums. But there's no doubt when we look at the annual and recent trends that the auction markets in Sydney particularly have picked up from where they ended last year, which is interesting because usually we start off around about where we end, but we've picked up quite strongly this year in Sydney and tracking well above where it was a year ago. Melbourne, a little bit lower than where it was a year ago, and still, we'd say, certainly underperforming compared to the other markets, but still a results there in the mid-60s, which gives some confidence to sellers going forward. Brisbane well ahead of where it was a year ago, and it also has had a strong start to the year, and we mentioned Adelaide starting to pick up back towards those 80% results and similar results to where it was a year ago. And maybe Canberra is the revival market moving into the 60s, but we'll have to keep an eye on that over coming weekends, Michael, to see if those Canberra results can be sustained. But certainly some good early signs. Of course, if you're looking for the latest auction clearance rates, my LinkedIn account, Andrew Wilson at LinkedIn, publishes the Capital City Snapshot every Saturday night at 6:30, and we get the full national report Sundays out at 9 a.m. But Michael also publishes that full weekend auction report. So look forward to that. And as I said, next weekend, Michael, we have back to a full weekend of activity, no distractions from holidays. And of course, it has been very hot in Adelaide and Melbourne over this weekend as well, but that hasn't slowed the market down. Weather never really does, interestingly enough.
Easter's a bit earlier this
Yes,
year.
yes, yes.
There's going to be a few auctions bunched in before Easter. So we'll see how the higher listing numbers test the market. Currently, there's sufficient depth. There's more than one buyer for most properties,
Yes.
and it's a good time for sellers. So we'll see what happens. The other interesting thing this month, Andrew, is that we haven't had a Reserve Bank discussion.
Yes.
Normally by this time we'd be
Yes.
talking about what the interest rate decision was. But this year the Reserve Bank's moving to 8 meetings a year rather than the 11.
Well, don't be too disappointed, Michael, because we'll have one next week. They're having a later meeting for March. So they're still going to have a March meeting, but it's going to come later in the month next week. And there will be no meeting in April. And then they're going to have an early month meeting in May. And then there'll be a later month meeting in June. So that's how they're working. And of course, April's a bit of a holiday month anyway. So I think that makes sense. I'm not sure how it works in the second half of the year, but that's why we'll be reducing, because we'll be having later meetings and then no meetings as a follow-up. So look, it makes sense, I guess. But of course, they can always call a meeting if they need to, but that usually causes more damage than good because people panic. But yes, no, we'll get one next week. Well, the week after next, we'll be reporting on it because the results won't be available until our following Monday week.
But I'm sure there's going to be lots of news to discuss. So I look forward to catching up with you again this time next week, Andrew.
Yes, thanks, Michael.